This report, dated December 3, 2025, analyzes the global financial system, highlighting a period of structural fragility and a liquidity paradox. Despite calm in headline equity indices, underlying financial plumbing shows stress, particularly in interbank funding markets, reminiscent of the 2019 repo crisis. The report notes a divergence between the market's optimistic view of a potential dovish Federal Reserve chair, Kevin Hassett, and the reality of a stressed repo market. Key issues include the Secured Overnight Financing Rate, SOFR, trading persistently above the interest on reserve balances, IORB, indicating balance sheet constraints for banks and a broken arbitrage mechanism. The Federal Reserve's overnight reverse repo, on RRP facility, is effectively exhausted, meaning new Treasury issuance directly drains bank reserves, contributing to SOFR spikes. While the broader economy has ample M2 money supply, the financial economy faces a liquidity shortage, complicating the Federal Reserve's policy decisions. Sovereign debt markets are struggling to absorb massive U.S. Treasury supply, with recent 52-week bill auctions showing waning demand and rising costs for the Treasury. Foreign demand for U.S. Treasuries is not expanding sufficiently, and rising Japanese yields could further diminish their attractiveness. The U.S. yield curve is experiencing bear steepening, while the Canadian curve is flattening due to strong economic growth. Globally, central bank policies are diverging. The Federal Reserve is under political influence, with markets pricing in a dovish pivot based on Kevin Hassett's potential nomination, creating a Hassett put for equities. The Bank of Japan, however, is signaling a potential rate hike in December, which could unwind yen-carry trades and pose a threat to U.S. Treasury auctions. The Bank of England has warned about AI-driven equity valuations, resembling the dot-com bubble, and is lowering capital requirements for UK banks to stimulate lending. The Bank of Canada faces a hold position due to surprisingly strong GDP growth, while the Reserve Bank of Australia is caught in a stagflation trap with slow growth and persistent inflation. The Swiss National Bank is contemplating negative rates due to deflation risks, and the European Central Bank faces a last-mile problem with inflation picking up despite sluggish growth. Equity markets are trading on a dual track, with the Hassett trade driving optimism while the Bank of England warns of a valuation bubble. Market breadth is narrow, and unusual options activity, particularly in silver puts and S&P 500 puts, suggests institutional hedging against liquidity events and flash crashes. Corporate actions include activist campaigns in micro-cap companies like Net Capital, insider buying at Blue Owl Capital, and M&A activity like Eventbrite's acquisition. In the crypto space, Bitcoin has surged due to regulatory comments, and a major asset management firm is now allowing cryptocurrency ETFs, potentially opening the door for massive inflows. However, the crypto rally is seen as fragile, driven by short squeezes rather than organic demand. In currencies, a strong macro divergence exists between the Australian dollar and the Canadian dollar, favoring a short AUD/CAD trade. The USD/JPY pair is volatile, with the Bank of Japan's hawkishness potentially leading to a stronger yen. In commodities, silver is vulnerable to a liquidity crisis, as precious metals are often sold to raise cash during such events. The report concludes with a strategic outlook, predicting that the repo squeeze will intensify, forcing the Federal Reserve to conduct larger operations at the standing repo facility. Upcoming economic data, such as ADP employment and ISM services, are likely to be mixed, creating volatility. High-conviction actionable opportunities include short AUD/CAD, caution on silver, and long volatility. The report emphasizes that the market is celebrating political change while ignoring mechanical failures in the financial system, with the SOFR IORB inversion serving as a critical warning sign.